Hey, welcome to our weekly segment where we guide you on your journey to financial literacy.
We like to make these videos short and sweet in hopes that you learn a new economic term while keeping you updated on 3 financial events that happened in the past week.
Without further ado, let's get right into it.
Last week's release of the minutes from the last Federal Reserve meeting revealed that discussions around reducing bond purchases have gained steam among Fed members. All eyes will be on Chairman Powell's speech at the Central Bank Symposium in Jackson Hole this week. And while we doubt he'll fully tip the Fed's hand, many do expect the Fed to begin communicating its taper timeline in more detail at the September meeting. Importantly, we don't expect a repeat of 2013's so-called taper tantrum, when the stock market dropped 5.7% in reaction to the initial mention of intentions to dial back bond buying. With one, the market having seen the taper movie before, it was new territory in 2013, and two, with the Fed learning from the prior experience and taking care to be transparent and communicative, we don't think the market will be caught off guard this time. This doesn't mean the taper is a non-event, but it does mean it shouldn't be a singular event that sparks an acute sell-off. While many don't think the taper itself represents an event risk, we do think it reduces the cushion for the markets to absorb future bouts of anxiety over economic growth, policy adjustments, or geopolitical uncertainties. There's little doubt in many's minds that the extraordinary level of existing monetary stimulus has played a role in the stock market tranquility this year, a period in which the S&P 500 hasn't experienced even a 5% pullback and has just seen 11 1% down days. There have been two 4% pullbacks this year, with stocks bounding back to all-time highs in an average of 13 days. As the amount of monetary accommodation is reduced gradually, many think equities may be more susceptible to short-term volatility and period pullbacks. Looking at 2013's taper announcement, the S&P 500 has experienced one 4% plus pullback in the preceding 12 months, but three such declines averaging 4.8% in the 12 months following. Many understand and anticipate the market's anxiety around a wind down in Fed support. At the same time, crisis level accommodation shouldn't be maintained indefinitely, particularly given the economy is well beyond crisis conditions. Unemployment is 5.4% and headed lower. GDP growth is on pace for the best year in 4 decades. Credit conditions are healthy, and inflation is running hot. Given this backdrop, many think it would be more worrisome if policymakers weren't considering a path toward less monetary stimulus. For comparison, at the time of the taper tantrum in 2013, unemployment was 7.5%, GDP growth was running below 2%, and core inflation was a scant 1.7%, which is why, at the time, the prospects of less Fed stimulus elicited a more skeptical, knee-jerk reaction at the markets. Anyways, that pretty much wraps up the financial news for this week. Now I'm going to hand it off to Om to discuss our financial term.
Hey guys, for this week's financial term, we're going to be talking about the concept of triple witching. Triple witching is a simultaneous expiration of stock options, stock futures, and stock index option contracts, all on the same day. It happens 4 times a year, once every quarter about. On these types of days, there tends to be increased trading volume and unpredictable price action due to the fact that 3 different option classes could all share the same underlying. That need to be closed generally involve some buying or selling of the underlying asset. When you exercise an option, you are buying and selling the underlying asset. The triple witching hour, or the final hour of the trading day, which is the triple witching day, can result in escalated trading activity and volatility as traders close, roll out, or offset their expiring positions. Futures contracts are one example of derivatives that are a part of triple witching. Nowadays, future contracts do come with a hefty price tag. In fact, one of the S&P 500's future contract is worth 250 times the index. Right now, one is worth a little over $1.1 million. To avoid involving that much money in a trade, investors and traders both either close or roll out the position. On the expiration date, contract owners do not take delivery and can instead close their contracts, selling the gain and loss from purchases and sale prices. Traders can also extend the contract by closing the existing trade and simultaneously booking a new option or futures contract to be settled again in the future, a process called rolling the contracts forward. This is a way to maintain the exposure to the underlying asset while keeping your collateral or the amount of money you could lose limited. Though much of the trading in triple witching days is related to squaring out a position, or in a sense closing, rolling out, or offsetting a position, the surge of activity can also drive certain price inefficiencies in the market, which we also like to call arbitrage, if you remember from our previous video. So these kind of opportunities draw in short-term arbitrageurs. So these opportunities, again, also result in extreme price activity in the last hour, because these arbitrageurs are attempting to put in a lot of volume into a guaranteed profit of maybe 1 or 2% to get cash on that price efficiency. A lot of people are doing the same thing. They're putting in a lot of money in the stock market. Thus, the volume goes up in that last hour. And these trades are completed in literally seconds, guys. So the amount of trades that could be going down in the last hour is insane to even imagine. So if you think about that, that also drives a huge surge in volume in the last hour. And that creates insane, inexplicable price action. And that's all for this video, guys. Thanks. If you enjoyed the video, please drop a like and subscribe if you haven't done so already, as it does help the channel grow. Thanks, guys.